All right, ladies and gentlemen, I hope you had a wonderful day. I got a lot of plays that we need to go over for the watch list today. But before we get into any of that, we got to talk about what happened today because we got the senior loan officer report, and it finally has evidence that credit is in fact contracting. This was the Fed survey. They delayed this from Friday, just came out today at 2 p.m. Eastern, and the whole thing around it was very unique, but let me show you the market. This is how we traded it. We had no action all day. Then we finally dropped like a minute or two after it came out. And then you had this wicked bounce, and then things kind of calmed down. And it was overall a pretty much nothing burger on the day. And then even actually besides that, we're going to get back into that. But it said stuff about credit, but let's jump to the bank stocks real quick, because in the morning and part of all of this, we were looking at a lot of things this week. We have a lot of expectations. Again, you have CPI on Wednesday. We have a big event with the debt ceiling tomorrow. Biden is meeting with everybody, but the bank stocks, remember the relief yesterday? Well, this morning, there was relief, and all of the bank stocks were up a lot. The regionals were doing good. Western Alliance and PAC W, they were doing very good. And even PAC West, they went up on news that they are cutting their dividend down to 1 penny, and analysts spun it as positive. So pretty much you only had bad bank news in the morning with PAC W. The rest of the banks, they were up a lot. But again, the story's not done because this was all pre-market. And then throughout the day, then especially after the loan survey, but really right off the morning, all of those banks sold off again. So it was a very interesting day. The volume, even on the market, was very low. But this senior loan officer survey now, I have a big theory I want to share with you. That's what I'm going to go over first. And then we are going to talk about plays. I got a light play with like Boeing, and we're going to talk a little bit about Google. But the last play we're going to talk about is the bonds. That's what I had up there. So Chad, God bless you. Hopefully we see you on stream, especially Wednesday morning CPI. And that's going to be interesting in and of itself. YouTube.com/the stock market. But let's get into this. So as far as this senior loan officer survey, that's what came out at 2 p.m. today. People are like, what happened? Did we announce World War II or World War III at 2 p.m.? No, it was the SLOO. It's like Senior Loan Officer Operator Survey. It's conducted by the Fed, and pretty much they talk to all of their banking officials, big banks, small banks, and they say, tell us about what you're doing with credit. I mean, have you paid down credit lines? How much are you loaning? What's demand looking like? All of that. So I'm going to give you a quick story with what we're seeing, but essentially the market took it as bad. The report was bad in the sense it showed that credit was tightening. Banks are pulling back on their loans, and even the people looking for loans, the demand, that was also dropping. So it was initially bad, but wait for it. I know you've heard this before. It wasn't as bad as expected, and that's still debatable now. And this is what I want to talk about, because what we kind of saw with that report today, my theory is it's going to take a little bit to digest until we see something else. Essentially, it reminds me of FRC earnings. Remember, FRC earnings came out. People looked at the deposit numbers instantly. They said that was bad, but it held up for a little bit. Then everybody looked at PAC W and Wall, and everyone's like, okay, so like a 17% decline in deposits. That's not too bad. It wasn't bad as expected, but it was still bad. And then everybody waited a couple days, but essentially either withstood the pressure or it didn't. And that's kind of how I think this survey is going to operate, just like the bank news now. We're getting this number, and the numbers that we got, the loan report, it showed that credit tightened about 2% quarter over quarter, which again, it's not a bad number. It's not like it pretty much, the reason why it wasn't as bad as expected, it did not show a collapse. You know, the face value of everything we got today, it showed, hey, you have evidence that credit is slowing down, but it does not show a collapse. So I guess it could have been worse. I know, very absolute and extreme. I get it. But the whole point with this is that it was showing a 2% move. It's now the first direction in credit tightening, and that's not a good sign. But then the demand for loans, like commercial and industrial loans, it plummeted. We're talking like 10, 15-year loans or 15-year lows, and that's just overall not good at all. So right now, it's kind of like like I'm saying, the last earnings we got with like FRC and even the banks, how everybody got the data, waited a little bit, and then we waited how the pressure played out. But now I also want you to think about CPI, especially if you've been watching it. I love you if you have been watching that long and long enough to understand this. But if you remember CPI both on the way up and on the way down as we documented all of it, and you got to live through it. But just remember at like various points, right, when like one data would tick up, it was like the start. The first time core CPI went up, that's kind of how people felt. They're like, okay, that's not good. It doesn't mean there's like a trend of that happening. It's not skyrocketing up. But the fact is 1 month does not make a trend, but every trend starts with 1 month, 1 quarter, one reaction. And that's essentially what is baked into the loan report that we got today. And you saw the action, but again, it was bad news, bad news. Yeah, people reacted bad, but then it bounced right back up, and then you see where we ended. So very weird to interpret, and that's why I think over the next few days, especially now with the CPI, that's what we're going to be getting from here. And then, like we said, there was a lot of bank activity. You saw the FRC or the, PACW and Wall and all the regionals are moving around, but for the rest of the week, we want to watch the reaction of the bank still. It still has been influencing bonds, more so equities and the sentiment people are feeling. Obviously, we have the data sets coming up, but it's either we get sufficient news on the banks that makes them vomit, or we keep doing this no news is good news, and then things kind of move in their own way until we get CPI. Then once we get CPI, everybody will start reacting. So that's pretty much it as far as anything else for the rest of the week. Again, big data on Wednesday, not much in the morning tomorrow, but then that debt ceiling news that we talked about, that meeting that Biden is going to be doing tomorrow, that is going to be a big deal. And we had a lot of extensive discussion, and we are going to keep talking about this. So come on, stream 2. I think we had a lot of nice discussions about a lot of things today, even what I'm about to get into with the bonds. I don't know, is that bugging you, the mismatch? Anyways, but you're like OCD. But we're going to wait for this debt ceiling stuff, and essentially whatever happens tomorrow, probably not going to be a resolution. We're going to get the same political stuff. We even heard more from Yellen today, but it's just like every single week from here. 2 more weeks, I'm about to start giving you plays on it. Again, we talked about this a lot today, but that's when we really start to worry. Essentially what we said, the base case for the debt ceiling, base case, you don't worry about it. Probably going to be a last second deal. However, every week that goes by and as we get closer to that date, the risk just naturally goes up, and there are just a lot of similarities to the last time we had to deal with this in 2011. So we'll see how that plays out. But other than that, we get into tomorrow, we get the data Wednesday. Let's see what's lurking with the banks, how people interpret it, and then even any other data from around the world, because we are going to hear from other central banks. But let us get into the plays. So I actually got a couple of plays here. I'm ending it with the bonds. Let me start with some easy ones. Number 1, Boeing. I bought these, I think it was like 207s or 212 calls. I bought 2 of them. I spent $60, but Boeing had a pop today on news that they're going to get an order from Ryanair. First, it was the rumor. Then it got confirmed a little bit, and they said that announcement should come later this week. So that seems like an imminent catalyst, but I threw $60 on it. I'm still short on those shares from the beginning of the year. So we'll see how that ends up playing out. But that's the first one. The second one now, Google, they had a pop after hours. I want to see how this plays out. They said they're coming out with a new generative AI model thing at their Wednesday conference. So it wasn't previously announced. The stock popped on it. Remember, the last announcement they had killed them. So it could be redemption. But again, AI's been all the hype. And then even AMD, we talked about that yesterday. You saw exactly what it did. It was amazing and massive considering how little we moved. Again, some individual names did go crazy. But now the final play, baby, bonds. I'm still short on this. We talked about it today, and I just keep thinking about it a little bit more. I'm saying short the bonds up until CPI or after. So you got 2 opportunities. You could short it until CPI. That's going to depend on certain things with the market, but in general, you'll see why I'm saying of why I'm feeling short the bonds specifically. I'm short on the 10-year right now. But even after CPI, depending on the signal we get, because like I'm saying, all of the events this week are going to get a couple of earnings. It's pretty much going to lead us in here until the next runway of like 5 weeks until we get into the next Powell. You're going to get another CPI and other things after that. But one thing that's been in focus in the bonds and the other big discussion beyond debt ceiling that we had today, especially with the banks and bank fears going higher and lower, earnings fears higher and lower, we are talking about all of the fear in the bond market and the fact that people are still talking about rate cuts. Again, I made that little short video, and just a couple of days ago, the Fed futures were at 50-50 for a rate cut in July. And that's wild, but this is what we're talking about, because right now the bond market is saying that the Fed is going to cut in July possibly, but even then, on the long end of the curve, the bond market, where bonds are priced right here, right now, they are saying we are going to get 3 rate cuts by the end of the year. Jerome Powell, as of a couple days ago, said, bro, we're got to our terminal, but we're still not cutting. We will get a summary of economic projections in June. And last time, from this time to like last February, the last time the bonds had this little hiccup, it was the same thing. Bonds were like, no. In the beginning of the year, Fed is going to pivot. Then by the time February came out, they're like, okay, maybe not. And then right after that meeting, they started to sell off. So we'll see how that dynamic plays out. But the way I'm seeing it, unless that inflation data is bad or those credit tightenings get like a lot worse, we're probably going to see higher yields. I don't think we're going to cut just yet. Now, our inverted yield curve timeline puts us within 2 months, but this is what I'm saying. The bonds could stay in this range. I'm now starting to feel a lot more short. I only have one short on it, so I am definitely flexible, and I do want to go back and forth on it, but as of now, it seems like the market is very optimistic that the last meeting, I'm still struggling to grasp it was a pause. I still think that's debatable, but it seems like the market was like, yeah, pause is a given, a granted, and is already talking rate cuts. And now the reason why, and this is the going logic pretty much to understand, the bond market is saying the Fed is going to be cutting several times by the end of the year. The Fed is saying no. And a lot of people are saying the Fed, look at unemployment, the economy, earnings, things aren't collapsing. The Fed could keep this as long as they did in 2006, which was 2 years. But what people are saying, hard economic data like the Philly Fed, the PMIs, and any of the composites and anything that shows contractionary or expanding, it's all down. GDP. People are bringing up the macroeconomic data crashes, and they're saying that's what the bond market is going off of to say an immediate recession or a recession is imminent and right around the corner. That's essentially what the bond market is saying, whereas Powell is saying, no, we got the jobs market and all that, and that's why all the data moving forward, it's pretty much going to clarify this, and that's what's going to give the bonds the volatility. So we'll see how it plays out, but for now, short on one, I'm starting to lean a little bit short. I'm eventually going to go long on the bonds. I think it's going to be one of the best trades either this year, maybe throughout next year or into next year. It all depends on how much time the Fed and everything gets bought out with, if you think about it. But for now, I think we're going to get a lot of back and forth, and I think we're going to get a lot of pump fakes. So we'll see. Talk to me about this on stream. We had a nice discussion about it today, but I enjoy this discussion, so we could talk about it again. But all in all, watch the bonds either before CPI and afterwards. It's going to give us a lot of stuff to respond to, and that's going to be our runway until we get to June in the summer. So I hope you're ready, but that is your watch list, ladies and gentlemen. Make sure hydrate, healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. I need you to remember what you're focusing on, bro. You know that the world, when they discovered the world revolved around the sun, that was a big, big development in the world, in your future. Imagine things. I don't know what you believe about the earth anyways, but all I'm saying, bro, what you're focused on in center. Again, I'm on this nature tip. Y'all think I'm crazy. I'm just going crazy. I guess I'll take it, man. But just seriously, bro, what are you focused on? Revolve around the goal. Remember, men who don't think and don't have goals. That's it. That's conformity. That's Earl Nightingale. Go read it. Strangest Secret. Stop playing. Is that awkward? It's awkward. Okay, I love you. Goodbye. God bless you, Chad.